Hello. We are working exam 1A that we took earlier this year in fall of 2015, and we're looking at question 14, which is journalizing some transactions. So the trick to journalizing transactions, of course, is to read the transaction, analyze it to figure out what accounts are being affected and which is the debit, which is the credit. So let's just jump right in and do our journal entries. We have Feeney establishing Baker Street Company. She did some transactions, and we're just journalizing them. So the first one is opened a business bank account with a deposit of $16,000 in exchange for capital stock. So what this is saying is Julia put in cash of $16,000 and got back out of the company capital stock. So cash increased for the company, and shareholders' equity increased for the company, right? So the accounts affected are cash and capital stock in the amount of $16,000 each. That was on April 1. Cash, capital stock, almost seems easy now that we're looking back on them. Next thing, purchased office supplies on account, $1,200. So that means we got in some supplies. Supplies are an asset, and we put an account payable on the books, right? So we've got supplies, asset increasing, that's one account. Accounts payable, liability increasing. All right, so there's my debit, no credit. No expenses involved yet because we haven't used any of the supplies. Supplies aren't an expense until they get used. So we got asset, supplies, liability, account payable, $1,200 on April 2nd. $1,200. And we did it. Next, provided some services in exchange for cash. So this is a consulting company. They did some work. They got paid cash, $4,500. So when you do work, that's called revenue. We're going to call it real estate consulting fee revenue because that's what we did. And we got cash in. So cash, the asset, came in. It increased. That's our debit. Revenue on the right. Revenues are our credit. April 3. Cash came in, so that's $4,500 debit. And of course, real estate consulting fee revenue is $4,500. It's important to make sure you're categorizing things as revenues or expenses because consulting fee could be an expense if it was what you were paying to somebody. It could be a revenue if somebody was paying it to you. So make sure you're clarifying revenue or expense. Okay, provided real estate consulting services and sent the client a bill for the fee, $7,000. So we didn't get the cash in, but we did get another kind of an asset called an account receivable. So we're going to have our account receivable increasing. So that's an asset, so that's our debit, $7,000, and the same revenue account increasing with a credit on April 4. $7,000. Got a receivable for $7,000, and that same real estate consulting fee revenue, $7,000. Next, paid automobile rental expense in cash. So that's an expense. We've used something up. We did a rental. It's done. It's an expense. $250. We paid cash. So cash going out is always going to be our credit. And expenses are liabilities when you incur them. All right. So auto rental expense on 4/5. Auto rent expense, and we paid cash. $250, $250. And we're done. Well, good luck with everything. I hope you have a great study session for the final and you do really well.